Well, hello everybody. I'm just cleaning up here a little bit as we're waiting to get on. It's 2 o'clock and it's time for today's edition of the COPEC Financial Wellness Daily Livestream Webcast. And we're real excited today to have Nate Quilter, who's a certified financial planner here with Retirement Strategies, who does a lot of work in the investment and planning world. And just wanted to go over a little bit of information for everybody to make sure that we're all up to speed on COPEC and what, some of the details about today's programming. Obviously, from 2 to 2:30, we're going to have a nice discussion here with Nate, again, about the OPERS pension, 403B, 457 plans. And for those of you that might be in the 401k, we can bring that in there as well. If you need to. And then from 2:30 to 3, we'll open it up for questions and so a little more interaction if we have any interest there. So the program, let's see, the program has, we've got some disclosures here for you. We want to make sure that there's full disclosure on COPEC, affiliated businesses, and because Retirement Strategies, who I also represent, is also a affiliated company, we have some extra disclosure there too. And so wanted to put that out there and take a few minutes and take a look at that, and we'll be back with you in just a few minutes or 30 seconds or so. So that's the disclosure. If you didn't get through it, you can screenshot it, or you can go to copeceducation.org, and there's full disclosure there as well. Special notes, again, COPEC is a 501c3 nonprofit organization that we were heavily involved with founding, and I'm president of COPEC, and our goal is to actually provide education to the community at no cost, no marketing, no sales, just really get some education out to everybody so that you can make decisions depending on what your needs are and what the topic is. And the financial wellness portal is really about bringing the whole financial world to you with tax and legal and planning and investments and a lot of other ancillary topics, caring for aging parents and budgeting and even some IT things which help you with making sure you keep your online financials safe, things like that. Over on the right, you see a lot of our guest speakers and attorneys and experts in their field, the Better Business Bureau president, a number of others. So we really bring in some experts to make this a valuable option for you to listen into. Technology, obviously we could have technology problems. If that happens, just be patient. We'll try to get it up and running as soon as possible. And sometimes that does happen, but we haven't had any problems yet, so knock on wood there, we should be all right. And questions. If you do have questions, just throw it in the Q&A. If I can get it in during the first half hour, I will. If not, we'll hold it to the second half hour and do some open dialogue there. Just go ahead and hit the Q&A and just type it in there, and we really would like you to do that so that we can interact with what you guys are wanting to hear. Holidays, just know that we're not going to be doing this on holidays, including like day after Thanksgiving, Christmas Eve, those types of things. And then feel free to share this with others. We really appreciate it. This is for you. There really, again, is no sales pressure, no cost. We just want this to be a platform for everybody to be able to utilize. So thank you for attending. Again, just a review of the portal. On the top left is what we're doing today, the Daily Show. Click on the blue link to get in, which obviously you did. And then the other orange links, those are upcoming programs and schedules. We're going to try to be 3 to 6 months out so that you have a number of options to you to, to review and see which ones you want to listen into and put it on your calendar. It'd be great to have you every day. If not, just pick the ones that you're able to do. Here's an example of that calendar. You can see today is the 13th, and we're going to be talking with Nate on the OPERS 403B and 457. The middle column, and this is actually coming up pretty soon. We've been doing this for about 15 years down at the Fawcett Center and also local libraries. And obviously with things being closed right now, we'll probably add a webinar on this, but this is an in-person program for people that are really digging deep into the retirement preparation, really giving you a lot of details, including Social Security, OPERS, STRS, estate pensions, 401ks, private pension plans, and really bringing that in to give you a good idea how to prepare and do that transition. And you can see the dates there. That one does require registration. So make sure you register for those, because we have to fill seats and make sure we get the right amount of either food or space and things like that. The last one, a lot of our experts actually do webinars for companies and a lot of outreach. And what this is instead of a company bringing us in to do for your employees, we actually do them live online, so anybody can log in anytime. Just like today, there's no registration required. You can log in, but it's more of a lecture series instead of a conversation. So actually, I'm doing the program tomorrow on the 14th, and it's retirement 10 years out. Some of the goal setting, some of the things you need to look at, a little crossover from some of the topics today, but it's a good discussion for if you're interested in that. If you do have a company, department, program that you'd like us to do a presentation catered to your employees or your team, we can do that. Just go here. You can look at a menu of topics we can do, and just let me know. We can make sure we get that set up for you. And lastly, if you have personal questions, feel free to go to this calendar, schedule a 15-minute. We're happy to get on line with you and see how we can help you, either give you the right direction or answer any questions you have that might not be, able to be done in this environment. So with no further ado, I keep working on the timing of this. I got it down to 7 minutes, and I'm trying to get it down to 5. I don't know if that's ever going to happen. But today we're actually happy to have Nate with us. Nate, thank you so much for joining us. Really glad you're here. Why don't you tell us a little bit about yourself, maybe private or professional, that we don't know, and let us know what we're going to talk about today.
I appreciate it. Thank you for having me. So yeah, my name is Nate Quilter. I'm a financial advisor with Retirement Strategies, a certified financial planner. Today we're going to be talking about OPERS, 403B, and 457 plans, but these topics are, those are pretty specific. It kind of spreads into, private employer plans as well as 401ks. So those all kind of combine together. But I don't have any really interesting tidbits about myself. I love the outdoors. I'll say that, I guess.
Oh, there you go. There you go. Well, that's excellent. Now, I know that you've been doing a lot of work with the state pension plans, and I know that you help a lot of people in that area. OPERS, STRS, SERS, FER. I mean, define that a little bit and what you found with the OPERS specific and some of the things that are unique there that maybe you can share with us.
Sure, absolutely. Yeah. There are different plans depending on where you work. OPERS is Ohio Public Employees Retirement System. So basically people who work for the state in general, or cities a lot of times, but they're public employees, and differs from like STRS is state teachers, SERS is school employees, but they each have their own nuances. But a lot of just generally speaking about pensions are the important things, and then each of them have their nuances that you need to kind of understand. And with OPERS, it's one of the biggest ones is really when you make the selection. So when you get hired, they're going to kind of just set you up as, hey, the default is you're going to be on the OPERS traditional plan, which is what we call a defined benefit plan. But you can switch off and you can select yourself to choose where it's a member directed or a combined, which is kind of in between, a combination of the two. So one of your biggest decisions is going to be right when you get hired, which way to go.
OPERS, STRS, SERS, what else is there? Those are the big state public ones, and you have to keep in mind that that's Ohio. So if you're listening from another state, you actually have different pension plans in your own state from it. But in Ohio, the OPERS is the big one, which is kind of what we're focusing on today, the Public Employees Retirement Plan.
Going back to that first choice you make, it's, the big thing is defined benefit or defined contribution. And that's the decision you're making. Now, defined benefit is where the plan promises you a benefit that's going to last your lifetime. So every month they send you a check, which is very similar to private pensions as well. The defined contribution is where actually you put money in, your employer puts money into that pot, and then you are actually in charge of making those decisions as far as the investments go. And then at the end, what your balance is going to determine how your benefits are determined.
So somebody that's in STRS or OPERS and they're younger, let's say they're 25 and they're just joining, or even maybe somebody's just joining at 50, kind of walk through what kind of experience they may have. And correct me if I'm wrong, when you talk about the 403B and the 457, I think Ohio State, then you have municipality employee. I mean, there's a uniqueness with Ohio State, right? Because isn't it a nonprofit and a government agency?
Exactly, and that's where so the 457 or 403B or 401K, when you hear those are the tax codes that just say how those plans work as far as the IRS is concerned, really. But yeah, so 457 plans are for government employees. 403B plans are for nonprofits, and 401Ks are for private sector. Now, but they're all pretty similar, but they, again, still have their little intricacies that each one has. But yeah, Ohio State is actually considered a government employee and a nonprofit. So you can actually contribute, if you work there, to both a 403B and a 457. And putting in the limit in each. So, for example, the limit to put into a 403B or a 401K or a 457 is $19,500 for 2020. If you're over age 50, you can do a catch-up where you get to add an extra $6,500 a year. So if you're working for a private company here in Ohio, your limit is $26,000 into a 401K. But if you're an Ohio State employee, you can actually do $26,000 if you're over age 50 to both a 403B and a 457. Now, for a total of 52. That's exactly right. Now, when I say you can, they allow you to do it. A lot of people don't have that kind of cash flow to do it, but if you have it, you're in a unique situation that you can actually contribute more than a lot of people can.
And understanding that those plans are above and beyond what a state employee is already contributing to the state pension plan, correct?
That's exactly right. So the 403Bs and the 457, those are voluntary plans. You can add into them if you want or not. With OPERS, if you're in a job that's covered by OPERS, there's an ARP and an alternative retirement plan. That'll be another discussion for another day. But unless you select the ARP, you're under that OPERS umbrella. And so that's considered non-voluntary. You have no choice but to have that payroll deduction, and your employer contributes to that as well. So you can do the 457 and the 403B. Let's say you're an Ohio State employee under OPERS. You're putting your 10% into OPERS. Your employer is putting the 14%. Depending on which way you went, those are kind of divvied up different ways. And then you can also put $52,000 in if you're over age 50 into 26 in a 403B. And 26 and a 457. So there are opportunities to save a lot of money. So if you're closer to retirement and you didn't save when you were younger because you were raising kids and maybe you want somebody who's staying home and buying a house, and this is your chance to really catch up if you have the opportunity. Or if you're younger, this might be a good chance to get ahead. If you have a big year, or you've got a spouse that's only going to work 1 year and then they're going to stop, maybe kind of load it up 1 year and either catch up or get ahead.
And there's catch-up provisions that if you're close to retirement, you can even do more in these plans. And one of the things that I think our listeners should understand is that there are times where, let's say, for example, that you bring in $60,000. And if you are 2 years away from retirement and you have enough income from one spouse and savings, maybe you received an inheritance or you have enough savings where this is a strategy where you could actually defer all of your money, basically, live off of the spouse, live off of the savings from the bank account at a low tax bracket, right? Then you get to defer those dollars for 2 years or 3 years or 1 year at a high tax bracket. Then when you retire, pull it right back out at a low tax bracket again, and actually make money by being strategic with how you can defer those dollars. Am I right?
That's absolutely right. And that's a big strategy we'll do. We'll have people say, like, I've got this money sitting in a cash account, or I inherited it, or whatever it may be, and it's sitting over here. But I want to put, I'd like to put extra in my 401k, but I can't put it from here over here. Well, yes, you can. That's exactly what you said. You just withhold more. Yes, your paycheck may not be enough to live off of because you've deferred more, but you can go take that money over from the cash account. And it's basically a way of going through to get it into that 401k. And that really just comes down to tax planning. If you're in a high tax bracket now and it's going to dramatically drop, or even considerably a little bit, drop when you hit retirement, that 1 year difference can make, you can save yourself 10% in taxes if your tax brackets line up correctly.
Yeah, and that's the thing that we always talk about. Everybody knows that there's a 10% penalty if you take your money out too early, right? But a lot of people don't understand that if you don't use some of these strategies, let me rephrase this. If you're proactive and you use some of these strategies, it is the equivalent or more than a 10% penalty. So the IRS penalizes you for taking out money too soon, but they also penalize you for paying taxes in a higher tax bracket. So if we can control those higher brackets, we're actually proactively controlling those extra penalties for sending money through the tax mill, right, at the wrong time. So by being aggressive and using other money temporarily and then taking it out in the future, it's still your money. It's just you got it out on sale rather than paying full price with the IRS.
Absolutely. And the way the brackets work, there are bigger gaps in them, so there are gaps that are 10% or 8% or 3% to the next bracket. And it's those 10% and the 8% ones that make the big difference. The 3%, hey, 3% is 3%. It's not as big as the 10 or the 8, but it's still, 3% that extra that you're giving to the government that you wouldn't necessarily have to if you plan ahead. So
yeah, and obviously for everybody out there, make sure that you check this with your accountant and verify that any of these strategies, because this is not advice, of course, but right, these are things that with these limits and the catch-up provisions, whether you leave it in there or you turn around and take it out when you're allowed to, and those types of things, those are things that are available to us under the current tax law. Got a question. So back to, again, if somebody's new and they're setting themselves up with the OPERS pension system, what are some things they need to think about at that time?
Really, one of the biggest things is, how long do you plan to work there? I think that's a big one in the consideration, and that's really hard to know. We have clients who, this may be their retirement job. They go work for a city, and in that case, hey, it's going to be short-lived. Maybe let's go with this plan instead of the other one. You need to look at how that payout goes, and how the pension is calculated, and how long you want to work there, how much risk you're willing to take. There are some people that are just like, no, look, I want no risk. I don't care if my account goes up. I just don't want to go. I don't want it to go down, period. Well, if that's the case, you might be better off maybe going with the pension plan. Not in all cases, but you may be better off that way, because then you're putting all that pressure on OPERS to have them make the results of the investments, because they've promised a benefit of X amount of dollars at this age based off your income. And that's something to keep in mind when you're looking at your statements, which plan you're in, because that's a big difference. If you're in the member directed plan, you're choosing the investments. How it grows is where your benefit comes later on when you retire. If you're in the traditional plan, we'll work with clients, and a lot of people will show me, hey, they'll say, hey, my OPERS balance is X amount of dollars. Are you in the traditional plan? Yes. Okay, well, to me, when I'm planning, for the next 20, 30 years, the balance in that OPERS traditional plan is irrelevant. What matters is what benefit are they going to pay you every year for the rest of your life. So when you're looking at that statement, more important than that number that just gives a balance is where it shows each year breakdown of, if you retire at 62 or 65 or 66, this is what the pension will be. That's actually the number I focus on when I'm planning. But also keep in mind, when you look at that number, if you're married, you also want to get projections then on if you want to add survivorship. So when you're looking at your statement and it gives that number for the pension amount, that's only on your own life typically. Whereas, a lot of married couples will want to add a survivorship option on. So, if something happens to me, my spouse gets 50% or 100% of what my benefit is. Well, in order to leave something for your spouse, it's going to reduce the amount of that pension that they show you on the statement. So I always suggest, especially if you're getting close to retirement, you request those numbers from OPERS, because those are more important than the balance you're looking at on the statement.
So you kind of have a nice segue there into, okay, we've set up the plan properly. We've opened up, obviously chose which of the state pension participation we want to have there. Maybe we do or don't do the 403B, and we work hard all our life, and now we're getting close to retirement. And we'll go back to early retirement. We'll hold that off for a second. But now it's time for me to get ready to retire. There's two things that come to mind. One is, what if I die, right? And then the other is, what if I retire? What happens if I die, and what are my choices when I'm ready to retire and to make those choices?
So the first one is, what happens if I die? That's something where you want to kind of know, are they taken care of? Whether it's life insurance, survivorship on a pension, or even, there are sometimes we'll work with people where we'll say, look, if something happens to you really early, an early death, in the next 5 years, 6 years, 7 years, that's very detrimental to the overall plan. But if you make it past that 5 or 6 or 10 years, whatever it may be, then things could be all right. Well, maybe you take the highest pension amount and leave no survivorship, but you buy a life insurance policy to cover that short term. So there are different strategies you can use if it doesn't look good, if something were to happen to you early, either survivorship, insurance, things like that. As far as things to think about when you're retiring, your age is a big one.
Real quick, go back 1 second. I'm thinking here, like correct me if I'm wrong, so if I haven't chosen a payout yet, right? What happens to the 403B? What happens to the 457? I put in $60,000 in my 403B, it grew to $100,000. What happens to it? And then I have a benefit accrued. How long do you have to work to accrue a benefit in OPERS?
5 years is basically the rule of this. I mean, there are a lot of, depending on when you started, what your age is, how long you worked, but basically okay. 5 years is where you guarantee that they owe you a pension, but you may have to wait until a certain age to get it.
But let's say we've worked there for 30 years, I'm 58 years old, and I happen to pass away. What happens to the 403B, and what happens to that OPERS pension?
So the 403B really it comes down to your beneficiary, who you have named as a beneficiary. So when you sign up for the account, you'll be able to name a beneficiary on the account. That's saying what happens if I pass away, what happens to that account? Who does it go to is who you're naming there. So careful, check your beneficiaries on those accounts, because if you started 30 years ago and you were dating somebody and then you broke up and you never changed it, that may be somebody that isn't in your life anymore, but the entire account would go to them if you haven't changed your beneficiaries. So it would go there. And then it depends on IRS rules as far as, is it a spouse? Is it a non-spouse? That kind of determines can they defer it for the rest of their lives? Are they going to have to take it out in 10 years or 5 years? It depends on who the named beneficiary is.
And as a special note, things like retirement plans, 403Bs, along with life insurance and others, those avoid probate. So if you have a will, your beneficiary supersedes a will. So you need to make sure you balance all of these things. If you have a trust, you have to make sure that the beneficiary is named the trust versus a spouse or somebody else. So estate planning, last week on Friday, we talked with Russ Golloway about beneficiaries and inheritance. And that's the reason why a lot of times your investment manager and your legal, they need to talk to each other. They need to make sure that these things are set up right so the estate plan matches how these accounts are set up. And correct me if I'm wrong, for OPERS, they would get money back, right?
Depending on the situation. So if you pass away before you make the election, but you were eligible for, again, all these, talk to OPERS, they're the ones who can give you all the details. But generally speaking, if I pass away before I made an election, but I was eligible for a benefit, my spouse can choose to take the pension amount or take the amount of the balance in the account, basically. If I've already started a benefit, and let's say hypothetically I chose no survivorship to my spouse, but I start my benefit and 1 year later I pass away, what they do is they'll look at what the balance of the account was and they'll pay at least that amount out. So if I had $100,000 but my first year pension was $10,000, there would still be $90,000 that I put in. But you don't get any of what your employer put in. It's just enough to reach your contributions in there.
Okay.
So they could still be, and OPERS, I believe, is a $2,500 death benefit as well. So there could still be a payout, but if you live just long enough where you get past that, where all your contributions were paid out, there could just be down to just that benefit or nothing.
Great. Hey, we got a couple minutes left here. I want to ask one more question. So early retirement, reduced, non-reduced, how does that work? I know that there's a, what do they call it? A PLOP, right? Partial lump sum optional payment, some of those things. So when you retire, whether it's a reduced or full benefit, maybe a couple pointers there.
Yeah, so when you, basically, OPERS has guidelines depending on if you're group A, B, C for what is, what you need to reach to get an unreduced benefit. If you start the pension before then, it's what's called a reduced benefit. So if you have, 29 years instead of 30, or you're 53 years old, depending on your group, instead of 55, whatever it may be, there are reduced, you can start a benefit, but it's a reduced benefit. And what that means is, hey, you're not quite that age that you hit it. Well, there are a lot of big opportunities there that a lot of times that reduction is very large. So I was working with somebody recently that it was, if you work one more year and a half, you get an extra $7,000 every year for the rest of your life. That makes people question that, like, hey, if your plan looks great and you don't need this extra $7,000, then who cares? And you hate your job, but hey, if you don't mind your job, an extra $7,000 a year for the rest of your life can have a pretty significant impact. And that's only for another year and a half of work. I'm going to go ahead and do it. So that's something to watch when when you're deciding your retirement date. If you're close to hitting that unreduced point, it may be, hey, look at those numbers and see what happens there.
And that's one of the values of having experience working with these types of organizations, because I know the state pension plans, they do an awesome job working with our clients and advising them. And to have, we're not here to replace OPERS or STRS or even Social Security, right? But the idea that we can help people look in a different perspective, or whoever you work with, think of the things that better your situation without that big of a inconvenience. Like you just said, have you thought about this and have you weighed this? Typically those government benefits, they'll tell you what it is, but they can't advise you.
Absolutely.
Whereas what an advisor could do is they understand it and they can say, hey, have you thought about this? And if you did this a little bit longer, and here's the trade-offs, and so be aware that you need, study it, ask questions, find out, poke around, look at different options and see what fits best for you and your family. So, hey, I want to thank you so much for joining us today. We're going to stay on for another half an hour. And if you have anything you want to wrap this up with, love to have you wrap this whole conversation up. And then for everybody else, get ready. If you have any questions, please send it through the Q&A, and we'll be happy to stick around as long as possible.
Great. Yeah. Thank you for your time. I appreciate everybody that's out there, and thank you for having me on today. Just to summarize, there are, these are very specific plans, OPERS, 403Bs, 457s, and there are a lot of intricacies of them, as as we barely even scratched the surface today. So, just make sure, take the time. If you're here today, you care, obviously, and you're trying to learn as much as you can. And that's what I'd suggest. Just learn as much as you can. Talk to other people who have that you trust, that have been through it. Even more importantly, talk to the actual organizations, OPERS, Social Security, because the OPERS and Social Security have ways that, Social Security may be reduced because of your OPERS. So there are different ways these work together. Just make sure you understand how they work, because it'll help you when you make the decisions, because a lot of these decisions are irrevocable. Once you select your pension option, you've selected it, and you can't go back and change it later. So,
Right.
Just learn as much as you can. And hey, that's why we're here, to kind of help you think about things that maybe you hadn't thought of before.
Well, thank you. Thanks, everybody. We will stay on. I know we got at least one other question. Appreciate you coming on today. For those that need to leave at 2:30, thanks for coming. And for those that are going to stay on, we'll be with you in just a few seconds here. So thanks for coming.